Imagine turning $10,000 into a staggering $2 million in a mere span of 18 months. It's the kind of financial transformation that most of us can only dream about. However, this is not just a dream, but a reality. The reality of a man named Nicholas Darvas. Nicholas wasn't your traditional Wall Street guru. He was an unusual character, a world-renowned dancer who managed to dance his way right into the world of stock trading and emerge as a millionaire. His secret to such extraordinary success was no magic trick, but something he developed on his own, a unique strategy known as the box theory. The name Nicholas Darvas may not ring a bell to you, but he was a very well-recognized personality in the mid-20th century. A professional dancer by trade, Darvas traveled the world, performing and impressing audiences with his incredible artistry. However, his connection with the stock market was purely coincidental. In the year 1952, while on a global tour, Darvas decided to dip his toes in the financial world and bought a few stocks as an investment. To his utter surprise, the stocks he had bought saw a significant surge, doubling his initial investment. This unexpected return piqued his curiosity, and he realized there was more to the stock market than meets the eye. Intrigued by this, he delved deeper, studying the stock market meticulously in great detail. He spent countless hours understanding market trends, examining stock patterns, and analyzing investment strategies. Through his rigorous study and determination, he created a unique trading strategy, something that didn't conform to conventional trading wisdom, the box theory. So, what exactly is the box theory? In essence, it is a technique or method that is used to track the normal range of a stock's price. It functions by first creating an imaginary box around these fluctuations. When we talk about fluctuations, we refer to the regular and normal price changes that a stock undergoes. These fluctuations can be influenced by a multitude of factors, including market trends, global events, or company-specific news. Now, once the box is formed, it serves as a sort of boundary or limit. Within the box, the price remains relatively steady and consistent, without any drastic or radical changes. It's like a safe zone for the stock prices. When the price breaks out of this box, either upwards or downwards, it is considered as an indicator or a signal. But what kind of signal, you may ask? It is a signal of a potential buying or selling opportunity. Here's where it gets interesting. Every from the box doesn't automatically mean a buying or selling opportunity. The direction of the breakout is what determines potential action. An upward breakout is generally viewed as a buying opportunity, while a downward breakout is seen as a selling opportunity. Now let's dig deeper into how Nicholas Darvas, the originator of the theory, used this approach. Darvas was not just tracking any and all stocks. He was selective and would choose only a few stocks he was interested in. Once these stocks were chosen, he kept a hawk's eye on their prices. He would meticulously note down the high and low prices of these stocks over a period of time. What was the purpose of this note-taking, you ask? Well, these highs and lows would form the box. This box was not just a simple boundary, it was a tool, a guide that helped Darvas make his trading decisions. If a stock's price broke out of this box on the upper side, he saw it as a golden opportunity to buy the stock. This was based on the assumption that the stock is on an upward trajectory and likely to continue rising. Conversely, if the price broke out on the lower side of the box, he interpreted it as a warning sign. It was time to sell the stock. The rationale behind this was that the stock was likely heading into a downward spiral, and it was better to offload it before it declined further. He would sell the stock. Darvas, in his journey of investing, was incredibly disciplined in his approach, which set him apart from the crowd. He knew that success was not born out of chaos, but a refined and consistent method. His strategy was a unique mix of careful planning, intuition, and sheer discipline, the key elements to his prosperous investing career. At the heart of his strategy was the stop-loss order. Darvas wasn't foolish enough to believe that all his choices would be winners. He was a realist, understanding that even the most promising stocks could fall. So to ensure his losses were controlled and his investments secure, he would set a stop-loss order at a few points below his buying price. This strategy allowed him to limit his losses if the stock price fell, keeping his portfolio balanced and his mind at ease. But Darvas was not just about limiting losses, he was equally focused on securing profits. understood that the stock market was a game of patience and timing, and he was a patient player. He would set a target price at which he would sell the stock. This wasn't a random figure, but a calculated decision based on thorough research and market trends. This target price was his beacon, guiding him to secure his profits if the price rose. In all, Darvas's approach to investing was a testament to the power of discipline, planning, and patience. His strategies are reminders that in the volatile world of stocks, one needs a solid plan and the discipline to stick to it. Intriguing, isn't it? The allure of the box theory is steeped in its breathtaking. It's an investment approach that spares you the headache of grappling with complex technical analysis or deciphering convoluted market predictions. This theory is all about taking a step back, observing the market with a keen eye, understanding the rhythm and patterns of stock movement, and making strategic investment decisions based on these crucial observations. The box theory is a testament to the timeless wisdom of its architects, a methodology that has withstood the test of time, economic shifts, and evolving market conditions. For over half a century, it has been guiding investors, proving its efficacy time and again. This theory, conceived in the 50s, continues to remain relevant and effective even in today's digital age, an era marked by frequent technological disruptions and rapidly changing market dynamics. With the box theory as your guiding principle, you can traverse the often tumultuous and unpredictable path of the stock market with greater confidence. It empowers you to make sense of the market's ebbs and flows, to identify opportunities when others see chaos, to anticipate trends when others are taken by surprise. It trains you to understand not just the what of market movements, but also the why, thereby enabling you to make informed, strategic decisions instead of relying on luck or speculation. The box theory isn't just about making profitable investments. It's about cultivating a disciplined, strategic mindset that can serve you well not just in stock trading, but in any decision-making scenario. It's about becoming an active participant in your financial journey, rather than a passive observer. And the best part? You don't need to be a Wall Street expert to use it. The box theory is designed to be intuitive and accessible, making expert-level stock trading strategies available to everyone, regardless of their level of financial knowledge or experience. Yes, with the box theory, you too can navigate the often turbulent waters of the stock market. So are you ready to dance your way to stock market success like Nicholas Darvas? You must be wondering, who is Nicholas Darvas? Well, he was a professional dancer turned investor who made a fortune in the stock market. He did so by applying what he called the box theory, an investing strategy that emphasizes timing above all else. This theory is what he attributed his success to, and it's what awaits you today. Now imagine yourself in an unpredictable dance, not unlike the waltz of the stock market. Every spin, every twist, and every turn is a new opportunity, a new potential gain or loss. The trick is not in executing the perfect pirouette, but rather it's in knowing when to make your move. Just like dancing, investing in the stock market is artful. It's about intuition, rhythm, and timing. You don't need to be a professional dancer or a financial genius to make your mark. You just need to understand the box theory and how to apply it. Mastering this strategy requires practice. But the beauty of the boxing theory is that it doesn't demand perfection. It doesn't ask you to land every jump flawlessly or to anticipate every fluctuation in the market. Instead, it allows for errors and encourages learning from them. The power of the box theory lies in its simplicity. It acknowledges the complexity of the stock market, but simplifies the approach to it. It's about identifying trends, understanding their potential, and knowing when to step in and step out. In essence, the box theory implores you not to focus on making the perfect move, but on making your move at the perfect time. Because ultimately, timing is everything. Are you prepared to embrace this approach and dance your way to financial success? Happy trading! Welcome to a new chapter in your stock market journey. We're excited to announce that we're starting a weekly list of breakout stocks based on the Darvas strategy. This list, built on the principles of the box theory, aims to help you identify potential investment opportunities and understand market trends better. The purpose of this list is purely educational. It's a tool to help you understand how the box theory works in real time. It's like a dance partner that guides you through the steps. But remember, the final performance is still yours to execute. Now, as we step into this new venture, we want to emphasize that this list is not an investment advice or recommendation. It's simply a tool that should be used in conjunction with your own analysis and understanding of the market. We encourage you to use this list as a starting point. Use it to identify trends, but always do your own research. Just like a dancer practices their steps before a performance, you too must practice analyzing the market before making any investment decisions. Remember, this is for educational purposes only and not an investment advice or recommendation. Always do your own analysis before investing. And with that said, we invite you to join us on this journey of discovery and learning. Let's dance our way to understanding the stock market better.